Canada just issued $3 billion in bonds, and not one U.S. bank touched them. This isn't just finance, it's a geopolitical line in the sand. What you're about to witness isn't your typical trade dispute. This is the quiet dismantling of a financial relationship that's defined North America for decades. While headlines focus on tariff wars and Twitter battles, something far more consequential is happening in the bond markets, procurement offices, and currency trading floors from Toronto to Calgary. We're witnessing a slow-motion financial divorce that could reshape North America's power balance forever. U.S. Canada economic integration, the bedrock of continental trade, is being stress-tested by tariffs, bond market rebellion, procurement wars, and a systematic financial shift that's flying under the radar of mainstream media. I'm your guide at *** Precious Update ***, your ultimate source for economic insights and geopolitical analysis. If you're ready to understand how money moves when nations move apart, hit that like button, subscribe, and let's dive into the financial revolt that's rewriting the rules of North American economics. Let's start with the shot heard around Wall Street, in what financial insiders are calling the most significant snub in decades. Ontario raised $2 billion in Yankee bonds without a single U.S. bank in the underwriting syndicate. This was the first time since 2011 that America's largest trading partner deliberately excluded Wall Street from a major bond deal. To understand why this matters, we need to rewind to the tariff wars. Trump's aggressive tariffs on Canadian steel, aluminum, technology components, and auto parts weren't just trade policy, they were economic warfare. For every dollar of Canadian exports hit by these tariffs, there were ripple effects through supply chains, employment, and most critically, financing arrangements that had operated smoothly for decades. Ontario's response was surgical and devastating. Instead of relying on Goldman Sachs, J.P. Morgan, or Bank of America, the usual suspects for large Canadian bond deals, they turned to Barclays and a consortium of Canadian banks including BMO, CIBC, and Scotiabank. The message was clear: if you're going to weaponize trade, we'll weaponize finance. But here's what makes this truly seismic. This isn't a one-off retaliation. Ontario has restructured its entire borrowing strategy. Of the province's projected $60 billion in borrowing this year, a full third is now set to bypass New York entirely. That's $20 billion in financial flows that would normally strengthen the dollar, support U.S. financial institutions, and reinforce America's role as the continental financial hub. The geopolitical implications are staggering. For 70 years, Canadian provinces have viewed Wall Street as their natural capital partner. Ontario's finance minister used to have Goldman Sachs on speed dial. Now, those relationships are being systematically dismantled and rebuilt across the Atlantic. If Ontario's move was a warning shot, Alberta's March bond deal was a declaration of independence. The energy-rich province floated €25 billion in euro bonds without Bank of America, ending a 6-year relationship that had financed everything from oil sands development to renewable energy transitions. This wasn't just about finding alternative financing. Alberta's decision represents a fundamental shift in how Canada's energy sector views its future. For decades, Alberta's oil flowed south to American refineries, financed by American banks, and priced in American dollars. That integrated energy relationship is now being systematically unwound. European players like Barclays, along with Canadian institutions TD and RBC, stepped in to fill the void. But the real story is what happened next. Alberta began rerouting oil exports, developing new tanker routes to Asian and Gulf markets, and most significantly, turning to European capital for infrastructure development. Walk through downtown Edmonton today, and you'll see the physical manifestation of this shift. Alberta's transport and logistics companies, the ones moving oil, grain, and manufactured goods, are increasingly financing their operations through Frankfurt and London rather than Houston or New York. Trucking companies that once secured equipment financing through American banks are now dealing with European lenders who understand energy markets but operate under completely different regulatory frameworks. This isn't just about diversification, it's about building parallel financial infrastructure that can operate independently of U.S. monetary policy, U.S. sanctions regimes, and U.S. political volatility. When Alberta's finance minister travels to Europe to secure funding, he's not just raising capital, he's building the financial architecture for a post-American North America. While bond markets grab headlines, the real revolution is happening in procurement offices across Canada. New rules now explicitly favor Canadian and allied bidders over U.S. suppliers, creating a systematic preference system that's quietly reshaping who gets to do business with Canadian governments. Here's a real example that illustrates the broader trend. A Swedish software company recently beat out a Seattle-based competitor for a major Ontario government contract. The American firm had better technology, lower costs, and established relationships, but the Swedish company won because procurement officials factored in foreign exchange risk and policy uncertainty when dealing with U.S. suppliers. This calculation is now being applied across thousands of contracts, hospital equipment purchases, infrastructure projects, IT systems, and even routine office supplies are being evaluated through a new lens that considers political risk alongside traditional factors like price and quality. The impact ripples far beyond government contracts. When public sector procurement patterns shift, private sector supply chains follow. Canadian manufacturers who depend on government contracts are increasingly sourcing components from European and Asian suppliers rather than American ones. This isn't anti-American sentiment, it's risk management in an era of unpredictable trade policy. For U.S. suppliers, this represents a slow-motion catastrophe. Markets they've dominated for decades are becoming systematically harder to access. The response has been predictable. American companies are establishing Canadian subsidiaries, partnering with Canadian firms, and in some cases, simply accepting reduced market share in their largest export market. But the deeper implication is more troubling for U.S. economic dominance. Canada is demonstrating that even the most integrated economic relationships can be restructured when political relationships deteriorate. Other nations are watching and learning. In the currency markets, something subtle but significant is happening. Vancouver traders are reporting liquidity issues around the U.S. dollar, not because of supply problems, but because of deliberate hedging strategies that reduce exposure to American monetary policy. Canadian institutions are quietly building what they call turbulence hedges, financial instruments designed to protect against U.S. Canada political instability. These aren't dramatic moves. No major institution is dumping dollars or making headlines. Instead, they're gradually reducing their dependence on Federal Reserve policy and building alternative frameworks based on European Central Bank guidance. Consider this example: a major Boston-based fund that invests heavily in Canadian assets has started hedging against U.S. Canada political risk. They're not moving assets or changing investment strategies dramatically. They're simply building in protection against the possibility that the financial relationship between the two countries might become less stable. This isn't full de-dollarization, but it's something potentially more significant: preparation for fragmentation. Canadian financial institutions are building the infrastructure to operate independently of U.S. monetary policy if necessary. They're stress testing scenarios where cross-border financial flows become politicized or weaponized. The implications extend far beyond Canada. If America's most integrated economic partner can build financial independence, what does that mean for the dollar's role as the global reserve currency? Other nations are undoubtedly studying Canada's playbook and considering their own hedging strategies. Nowhere is this financial shift more consequential than in Ontario's automotive sector. Ford, General Motors, and Honda all operate major facilities in the province, employing hundreds of thousands of workers and representing billions in investment. These operations have traditionally been financed through U.S. capital markets and integrated into North American supply chains. But the new financial reality is forcing difficult choices. European financiers increasingly apply ESG mandates that may clash with traditional automotive manufacturing. Electric vehicle development gets easier financing than internal combustion engine production. Clean energy initiatives receive preferential treatment over carbon-intensive operations. This creates a bizarre situation where the future of Ontario's auto industry may be shaped more by who funds the factories than who buys the cars. European banks willing to finance electric vehicle production are gaining influence over American automakers operating in Canada. The result is an acceleration of the electric transition driven not by consumer demand or government regulation, but by the availability of capital. For automakers, this represents a new kind of strategic challenge. They must navigate not just market competition and regulatory requirements, but also the political preferences of their financial backers. A Ford plant in Ontario might find itself pushed toward electric vehicle production not because of American corporate strategy, but because European banks won't finance traditional automotive manufacturing. The broader implication is that North American supply chains, built over decades of integrated economic policy, are beginning to splinter based on the political preferences of capital providers. This isn't market-driven disruption, it's political-driven restructuring of industrial relationships. Step back from the individual moves, and a pattern emerges. Canada isn't just retaliating against American trade policy. It's systematically reorganizing its economic relationships and building the infrastructure for strategic independence. This represents something unprecedented in modern North American history. For 70 years, economic integration has been the dominant trend. Trade deals, supply chain optimization, and financial market integration have created the most prosperous economic relationship in global history. That integration is now being deliberately reversed. Canada is writing a playbook for how nations can disengage from dominant partners while maintaining economic prosperity. Every bond deal, procurement decision, and currency hedge is a test case for economic independence in an era of political volatility. The financial map is being redrawn. Where once all roads led to New York, Canadian capital is increasingly flowing to London, Frankfurt, and Brussels, one bond deal at a time. Wall Street's grip on the Canadian economy is weakening. Other nations are watching. If Canada can successfully reduce its dependence on American financial markets while maintaining economic growth, what's to stop Mexico, Japan, or European allies from following similar strategies? The American financial system's role as the global hub depends on voluntary participation. If that participation becomes conditional on political behavior, the entire system becomes vulnerable. This brings us to the fundamental questions that will define the next decade of North American economics. Are we witnessing a permanent financial divorce, or is this just political theater that will end with the next election cycle? The evidence suggests this is structural, not cyclical. The financial infrastructure Canada is building, the European banking relationships, the alternative procurement systems, the currency hedging strategies, these aren't easily reversed. They represent investments in economic independence that will outlast any particular political moment. Will other nations follow Canada's model? The incentives are certainly there. In an era of weaponized trade policy, economic independence becomes a national security imperative. The tools Canada is using, alternative financing, procurement preferences, currency diversification, are available to any nation willing to pay the short-term costs of reduced efficiency. Could the EU or China capitalize on the split between America and its closest ally? European banks are already filling the void left by Wall Street's exclusion from Canadian deals. Chinese investors are increasingly welcome in Canadian markets where American policy uncertainty makes U.S. capital less attractive. What's next for U.S. Canada industrial integration? The physical infrastructure of economic integration, the pipelines, power grids, and transportation networks, can't be easily unwound. But the financial relationships that support that infrastructure are proving surprisingly fragile. For U.S. suppliers being squeezed out of Canadian markets, the choice is clear: adapt to the new reality or lose market share. Some are establishing Canadian operations, others are partnering with local firms, and many are simply accepting reduced access to their largest export market. The broader implication is that economic relationships once thought permanent are proving remarkably malleable when political relationships deteriorate. If Canada, America's most integrated economic partner, can successfully reduce its dependence on U.S. financial markets, no economic relationship is truly secure. This is the story mainstream media isn't telling. While attention focuses on tariff disputes and trade negotiations, the real action is in bond markets, procurement offices, and currency trading floors. The financial architecture of North American integration is being quietly dismantled and rebuilt along new lines. The question isn't whether this trend will continue. The investments have been made and the infrastructure is being built. The question is whether American policymakers will recognize what's happening and adjust their approach, or whether they'll continue to assume that economic integration is too valuable to sacrifice for political objectives. What do you think? Are we witnessing the end of North American economic integration, or will these financial relationships prove more durable than current political tensions suggest? Drop your thoughts in the comments below. And if you want to stay ahead of the financial and geopolitical trends that are reshaping our world, subscribe to *** Precious Update ***, where we decode the complex intersection of money, power, and policy. Hit that notification bell, and I'll see you in the next deep dive into the forces driving our economic future.